One of the most important principles in financial accounting is the matching principle. In terms of this principle, accountants are always trying to subtract the expenses of a period from the incomes of the same period in order to arrive at the profit or loss for that period. Obviously, it would make no sense to be subtracting the expenses of one period from the incomes of another. The result would be nonsense. And this, of course, means that accountants have to be very clear about exactly what period they are talking about, when it begins and when it ends, and they call that the accounting period. Now, usually for most companies, listed or otherwise, the accounting period is 1 year, which begins and ends at their financial year end each year. And they call this the financial year, right? So, in terms of the JSE rules, the company must produce its financial statements within 3 months of the end of its financial year each year. However, the accounting period could also be for 6 months. For example, the interim accounts, which are after 6 months of a company's financial year, are obviously for that first 6-month period. So you need to look at that. And it can happen that a company can have a 3-month financial year if it reports quarterly, which some companies, for example SAPI, would do. And then also, on the odd occasion, you'll find a company which has either a 7-month or a 15-month or some other period of financial accounting period. And that is because they have probably been the subject of a takeover, and their objective is to align their financial year with that of their new parent. You need to look in your stock exchange handbook to see the financial year ends of all the listed companies. Take the time to look in the handbook and take a look at the financial year end of the company that interests you.